Hey everybody, this is Jose Blasco. We are ready to get started in just a few seconds. Let's have a quick sound check as always. A quick message on the chat box would do just a quick hello. That will basically let me know that you guys hear me well, that technology is good, sound is good, and therefore we're ready to get started on time. So please go ahead and type a quick hello on the chat box so I know all is good. Thank you very much. I will be turning on my video stream as well in just a sec so we can be more and better connected. Here I am on the bottom right corner of the screen as always. Okay, so we are 10 seconds away from getting started. Wonderful. How are you, Christian? How are you, everyone? Good to see you all. We are starting right now. We are live, everybody. Welcome to the session, everyone. Today is March 24, 2021. This is Options with Options. As always, options give us options, isn't it? So again, delighted to have a tool to adapt to the market environment so we can take advantage of market opportunities in a way that is quite smart, isn't it? Options are very sophisticated as a trading instrument. So before we get started, as always, I would like to highlight on the upper left part of the screen the financial disclaimer. So please go ahead and read it carefully. This is important information. Please do not skip it and do not read a couple of words and that's it. Just read it completely. That's what I'm counting on you to do since it is, as I said, important information. Okay. And as we are ready to get started, we would like to rephrase the agenda, which is again like trading. We are mechanical, individuals, applying methods that we run in a way. Let's call it a cycle, if you wish. So we can produce consistent action leading into consistent results. Well, the way we are conducting the sessions for you guys when it comes to coaching is also following the same process, right? So, first of all, always we say hello, we talk about disclaimer and so on. Then I like to remind you the fact that we are simulcasting as there are multiple consequences or if you wish, the fact that technology, depending on if you are connected with YouTube or Facebook or other ways, or including our private coaching rooms in our website, tradewithufos.com/live. So depending on where you're in the world as well, so there is different latency for the transmission of the video signal, and therefore there may be a little bit of either video lag or chat lag at times. So I would like to make sure that all of you are ready to interact. And when that's the time, you have questions or we need answers or, any sort of interaction, let's make sure that you guys are on top of those chat boxes so we are, acting efficiently. The session, as always, we're going to be looking at the market first. Then we'll be looking at reviewing some of the trades that we have running. How are you, Joanne? It's very good to see you. And from there, we're looking to identifying new market opportunities and put them together and ready to execute. As always, the session is being conducted in multiple places. As I said, we are simulcasting, meaning that in our private trading room on our website, the session will be full duration. In public spaces such as YouTube, Facebook, and so on, the session will be limited in time, maybe around 30 minutes or so, depending on what we are doing. We will not, of course, interrupt any trade plan, any explanation. But the moment it will be time to, discontinue the stream in those public channels, then we will. Okay, so just keep in mind that the scenario, if you wish, the model that we are utilizing in how we provide tools for coaching purposes. Basically, we've been gathering your feedback, guys, for a few years now, and basically what we are doing is that we are giving two tools. Okay, one for the traders that you are looking at trading, let's say part-time, and you want to attend, some coaching, but limited duration coaching. Then you can just do it in free channels such as YouTube. For the ones of you that are more into it and you are, your intention is to become that super trader in the world. I always like to use that term, but again, it's all about how devoted you are, how committed you are, how much passion you have into this. To me, I never got enough, right? I love it. So if you are like me and you are that super trader in the world, so then ideally you want to be subscribed to one of our coaching plans, and then you get access to the full duration sessions inside our website. Okay. Ahmed, how are you, my friend? Mark, good to see you as well. Very nice, everybody. Very nice, everybody. Let's get started. Okay, now that the session is officially introduced and everybody is now around and ready to get started, so let's begin. Okay, so first of all, as we said, we're going to be looking at the market conditions to understand where we're at. For sure, I'm pretty positive that everybody has realized in the past few days the market has been pushing down with some intensity. Actually, some red UFOs have showed up. When looking at the S&P 500 ETF, and also not only that, we can also see the climate changing from blue to red. Okay, now I have to say, if I was to zoom in, that what we've got in recent times when it comes to climate, it's really more lack of climate than defined climate, right? Because that was thin dot, thin dot, thin dot, then a couple of thick dots, but then back to thin, then back to red, then back to blue, and thin dot again. So lots of indecision, which may have a lot to do with the fact that we are, from a fundamental point of view, we are still discovering if the vaccines will help efficiently people and therefore the economies or not. We are still finding out, if the market making all times high will actually continue, or in the end, it's just going to be a very intense day, or sorry, a very intense year. I meant to say to the downside, starting in let's say the second quarter. Again, there is a big fight out there with many people thinking the market is going to go up and buying, and a big fight with people thinking the market is going to go down and selling. And this is what we see now with those very powerful UFOs that just showed up on the 55-minute time frame of the S&P, as well as those continuous changes of climate. This is basically telling you what it is. Okay. Now, what's interesting to see though is that while the market has been falling, and it's not been a bad or a weak fall in recent times, actually we get now the VIX to be below 20. I mean, just a little bit below 20, 1938. It's not like it's a big deal. But again, it was a long time ago we were not below 20 when it comes to the VIX. Okay, I think that we had a little tease there in October last year. Okay, little tease kind of like going below 20 and then back up. But the last time that was the case, I mean, if I go to a weekly time frame or something like that, well, we need to move back all the way to February 2020 or something like that. So again, right before when the pandemic started. So it's like, the implied volatility built in these options. Okay, it's kind of like back to normal, if you wish, to what a normal world would be, where funnily enough, we all know the world is still far, far, far away from normal, with the pandemic still out there. Okay, so careful, because we may have many sort of surprises out there with very intensive moves. And what's difficult to understand or predict is if the moves in the market are going to be up or down based on what we saw with the climate and the UFOs, in the prior chart. So it's very difficult to predict, but I would not be surprised if everybody gets so calm now that people believe nothing's going to happen. And next thing you know, the market just either rallies crazy hard or crashes crazy hard. Okay, that's something that I would not be surprised about. Okay, so just warning a little bit of maybe some volatility coming in the future times soon. Why am I calling this a warning? Well, personally, I love volatility. No volatility is boring. No volatility means making money slowly. Volatility means making money faster if you know what you're doing. So I welcome volatility, but I also understand that probably some of you are in learning stages, okay, and therefore make sure you manage your emotions, make sure you don't over position yourself, make sure you don't over trade, keep it cool. And if it's a bit too much for you, if what's about to happen, you happen to feel that's a bit too much for you, you can always, discontinue trading for a week or two, cool down, and then get back in, okay? Because again, those are the times where, we may get to see another very, very intense rally, okay, or crash in the markets. I mean, again, going back to November, which is when the last time we saw volatility going below 20, okay, which is where we are now, okay? So if you look at the S&P and you look at what happened starting in around November, I mean, you can see the movement that took place. let me do it like that. You can see the movement that took place. I mean, this is really not a joke. The market has been moving more kind of like flat for some time now, since let's say February or so. But from November to January, February, it was very, very intense. Okay, and we saw the VIX again go back up, going back to back to those November levels. Okay, we saw the VIX going back up to the 30 level. Okay, this peak here, I'm just gonna ignore it, and and that one here, that was the election. So we'll, those are, let's say, unique events. Okay, so I'm just talking about something that is more kind of like common to happen, instead of looking at very unique or extreme type of situations. Anyway, so this is what we have out there with the market. Okay, so again, exciting, because if we have some moves and we catch them, they are likely to be fast, and in the meantime, exploiting those non-directional trades, it's certainly a good thing to be done. Okay, so let's go ahead and review the trades that we have running. The first one I would like to discuss with you, and we have work to do here with Facebook today. Okay, you will see. So the first thing I would like to discuss with you is the trade that we started in February 4, that concluded last Friday, which was March 19. So the idea was to stay within the purple area all the way to March 19. And yes, indeed, we reached that price point around 290, on that last Friday. So for the ones of you that took that trade that we planned, a long time ago, that was again February 4, well, then congratulations, you had a complete full profit. Okay, great. But so that trade is over, and again, we talked about it last week, and I said I would have that final visual as I just did. But it was pretty clear last week, as we said, that it was kind of like almost a sure thing now that this trade would end up as a profit, even though there is nothing guaranteed in trading. But it was extremely likely after all the time in the trade and where price was within the purple area. So that's over now. Okay, now what do we have in front of us? And still with Facebook, well, we have another trade that we put together in March 10. It's an iron condor utilizing April 16 expiration date. And here you can see already, we talked about it last week. Okay, we talked about it last week. We can see that last week when I did the probability calculations, we saw that the upper part, the dotted line on the upper part, was now hitting 310, meaning that from now until April 16, it will not be a crazy thing to expect Facebook to reach 310. And that, my friends, is a bad news, because that would put prices of Facebook above 303.74. And again, we were selling the 305 calls here, and that obviously would produce a loss for this trade. So that was a bad news. Okay, now thank God that we use the technology we use in putting the trades together. We had a beautiful UFO there ready to defend ourselves, and yeah, definitely price hit the UFO, and then price started moving back down. So thank you very much, Mr. UFO. This is giving us the opportunity to stay longer time inside the range. Okay, and that's very good in the sense that the longer we stay in the range, the more the probability to end up in a good position, or if we're gonna have to tweak that particular trade, doing some changes with the options and the strikes and so on, well, the longer you stayed in the range, the more time decay you have accumulated, and therefore every day that time passes, the pain you would get if we end up wrong on the trade, then that size of a pain, it's decreasing and becoming less of a loss. So thank you, Mr. UFO, again, for helping us to stay in the range for a little longer. Okay, but at the same time, the trade is not looking good. Okay, at the same time, the trade is not looking good. So while it's nice to have that UFO there to defend ourselves, which again we always look for 2 UFOs above, 2 UFOs below minimum because of this. Okay, so great visual, and if you are new to the sessions, this hopefully helps you very much to understand why we do the things the way we do. But at the same time, the trade is not looking good. Okay, so let me explain why I'm saying the trade is not looking good. So I'm going to load Facebook on Option Station Pro. I'm going to move to my analysis tab, and I'm going to recalculate for this iron condor. Okay, this iron condor, which is currently showing, is that the same one I had here? Yes, is the 16. So it's showing $44, $45 of loss. If I show you that same iron condor on TOS, it's showing minus $36 of loss. That's what that iron condor is currently showing. You can see a slightly better P&L on TOS, and I believe I commented that before. TOS, when you execute trades in a simulated account, they would always give you the pricing or the fills to happen exactly at the midpoint of the bid-ask spread, which is a bit too optimistic. Okay, but I mean it's okay for practice, but just know it's a bit too optimistic, and that's why we see a little bit of a better P&L with TOS instead of TradeStation in that particular case. TradeStation does the opposite. They only give you fills using market prices, meaning you buy from the ask, you sell to the bid, which is the worst price you will get. Okay, so this is like training with weights. Okay. Anyway, so going back to Option Session Pro, when I look at the analysis tab, you can see that the 1 standard deviation above and below is now pointing at 267 and 315. Okay, so 267 and 315. So 367 is okay. Let me move the line. 367 is right here. Okay, but now 315 is more or less there. So not only we were likely, or it was a strong possibility for us to be above 3 or 374 on the expiration date, it's actually getting worse. Okay, it's getting worse in the sense that now what's likely going to happen, okay, what's likely going to happen now, it's to go ahead and reach all the way to 315, which is increasing the probability of this trade to end up as a problem. Okay, so we're gonna have to deal with this, okay, and work on some adjustments and tweaks to keep working on improving the potential outcome of the trade. And I'm not saying that I have a kind of like a magic wand where I'm going to turn around a losing trade into a profitable trade. But certainly we're going to work on it to at least achieve the goal that if we end up losing, the size of the loss of this trade will end up being much less than the size of the loss we were expecting to get from the very beginning. Okay, so that's the idea. Okay, how can I do that? Well, so far, acting on the trade and getting out of this trade, or doing a very aggressive change on the philosophy of this trade, that would be a mistake. Why would it be a mistake? Well, because we are still in the range. Again, why would you go too aggressive with changes on the trade while the trade is still doing what we were expecting to do, which is to stay in the purple area? So again, we have the risk that now we may reach 15, and that's a risk, an additional risk that we didn't have before. So that's why I'm going to do tweak number 1. But at the same time, I don't want to transform in a major way this trade, because we are indeed still in the range. And not only that, the UFO is still there too. So again, if price was to come back, again, the UFO being here, still showing that unfilled orders are still available, and price may go back down, right? And again, so I don't want to give up on the trade, even though there is additional risk now, and I'm just not going to sit here and hope. If you were to trade stocks or futures or forex, then yeah, there is no other thing than basically just go with the plan and just wait to see what the market's going to do, because it's going to do it anyway, and you cannot control the markets going up or down. But with options, you still cannot control the markets going up and down, but you can change the impact on your trades by varying the options contracts that you use, the strikes, the expiration dates, the contracts you buy, the contracts you sell, because options give you options, okay? Which is something you cannot do when you go long or short. I mean, when you go long or short, the most you can do is to scale in or scale out, vary the position size, and certainly it could be useful too. But with options, we can get a bit more, sophisticated, if you wish, and do fancier things. So what is the first thing I'm going to propose us to do here when it comes to managing this iron condor? Well, if you look at the iron condor here, we look at I'm going to expand Facebook here, okay? And you look at the iron condor, of course, we have the put side, and then we have the call side. So what's happening to the put side if you look at the P&L of the put side carefully? Well, one of the puts is paying us 182, while the other put is making us lose 139. So in other words, if we were to close the put side, okay, if we were to close the put side, next thing you know, we would be able to collect here, let's call it $42 of profit just by closing the puts. Well, on the other side, if you were to look at the call side, is the opposite. So the call side is losing 258, one of the calls, and the other call is making 179. So if you look at the difference, that is actually a loss. Okay, and that the reason why we have a loss on the call side, it's again, I guess it's common sense. It's because we are far away from the midpoint of the range, which is where we started the trade. Okay, that was the ideal place where to be. We went with this beautiful, extremely powerful move to the upside on Facebook. Kind of a surprise, isn't it? So we went far away from the midpoint of the range, and therefore, who is suffering? It's the call side, because we are closer to the top than closer to the bottom. So again, the call side is painful, while the put side is paying us. Okay, so that's the first thought I want you to keep in mind as I'm gonna go over the changes we're gonna make. But what else is happening? Well, the other thing is happening is that because Facebook has been going higher, many new UFOs have been forming. Okay, many new UFOs have been forming since we took the trade on that particular date. Okay, many new UFOs has been forming. And on top of that, now the new calculation of statistics tells us that, indeed price is not likely going to go below 228. Actually, price is not even likely going to go below 267. And again, those are statistics to have a reference point. We could be wrong. Okay, we could be wrong. But certainly it's looking like a reasonable thought to not to expect Facebook to go below 267. So what is the change I'm proposing? Well, the change I'm going to propose is to go ahead and shrink our Iron Condor to go from that 228 level to go below. Oh, sorry guys, I'm just moving a UFO instead of moving my line. Just below that UFO here at 255. In other words, we have the 230 and the 225 puts there. So I'm gonna propose to close them, and therefore we're gonna go ahead and we're gonna collect $40 of profit, $42 of profit. That will reduce the risk of the trade by 40. And then we're gonna sell a new set of options here using the 255 to 40. 255 to 50. Okay, same distance, $5 strike price increment here. So we're gonna go for 255 to 50, and that is gonna add new premium coming in. Take a look. If I look at April 16 and I right click to analyze and sell vertical spread, okay, just to analyze it, and I was to go ahead and look at what happens if I sell the 255 and I buy the 250. Okay, so this is telling me that I would be collecting $29 extra. Okay, I will be collecting $29 extra plus $40 I am already making in this trade. Okay, I am already making in this trade. So in other words, I am collecting more premium on top of those additional $40 which I'm already making. Okay, so this is gonna be the first action that we're gonna take. Okay, and I just want to reconfirm something here, guys, because I'm a bit surprised for the low premium that we're getting here. So the trade price that we got when we did the trade was 226,177. So let me do the math. So 226 minus 177. Oh yes. So 226 minus 177. That is $49. Okay, $49. So notice that if I close the put side now, out of $49 that I collected in premiums from the put side, I'm going to make 42, which is almost the whole amount. And by selling the new set of puts, now I'm going to be in business for another additional 29. So instead of making 49, I would be making 42 plus 29. Basically, I am adding more premium to the trade. This is step one on the tweaks that I am going to be presenting to you guys on things that we can do, okay? How are you, Priyamanto? It's good to see you. Very good. Wonderful. Wonderful. Thank you. I'm reading your message. Thank you for that. So, so in other words, and please give me some confirmation on the chat box, guys, if you guys are following that initial set of thoughts that I'm sharing with you guys, that, you know, we're going to close for almost full profit the puts we sold originally, and now we're going to roll them up and sell new puts below 255 to collect more premium, and still be working on the statistical range, you know, in this trade, which is supposed to not to go below 267. But just in case that market keeps going higher, and then we're going to be in trouble with the Iron Condor, because we will be breaking the range and going outside from the range. So that now we would be, you know, at least suffering a bit less pain because of the additional premium that we are collecting on this tweak number one. Okay, very good. Okay, so let me implement tweak number one, if that's okay. And as I implement tweak number one, later I'll talk about what else we're gonna do if Facebook continues moving against us, because I'm calling this tweak number one. I'm not gonna say that we're gonna make this change and then hope for the best. Okay, so there is more to come that we will be exploring with other actions to be taken if this market, if this trade was to continue moving against us. Okay, and in this case, it's not like it's moving against us, because again, it's still inside the range. But the fact that it moves so high, probabilities now point at potentially reaching 315. And on top of that, we only got one red UFO above. All of this is really, you know, putting this trade potentially in trouble. Okay, so that's why we're going to start doing a series of tweaks to help the trade. Okay, Maca, Jose, I have just different numbers. I'll send you an email with the screenshots after the session, if that's okay. Yes, of course, absolutely, Maca. Very good. And you may have different numbers because, you know, maybe you were filled at a different time or something. But again, I'll be delighted to take a look. Okay, so so let's go ahead and do that first week. So how are we going to do the first week? Again, what I want to do is I want to close the put side of the condor to sell a new put side of the condor with different strikes. So again, one way to do it would be to create a closing order, and I can just you know, buy back the vertical and then sell a new one. This is definitely a valid way on how to do it. Another way to do it, maybe a bit more aggressively, is to create a rolling order. Okay, to create a rolling order, even though a rolling order, let me show you. So if I click rolling order, okay, it's gonna give you all those different, you know, possibilities here. But really, a rolling order, typically what's gonna do, it's gonna use different expiration dates. That's what rolling normally refers to, rolling to a different expiration date. So I don't want to roll to a different expiration date. I just want to roll up in strikes. Okay, so then if you're gonna do a rolling like that, then you will need to come here and, you know, make sure that you are changing back to April 16. Okay, and here it says vertical roll may not have identical components. Okay, so again, now I'm gonna have to change the strikes. So I'm gonna be buying the 230 and selling the 225. Those are the two options that we had. And then using the higher strikes, I'm gonna be selling the 255 and I'm gonna be buying the 250. Okay, which is 5 strikes below. Okay, and it seems that I could do this roll for 20. Earlier it looked like it was going to be around 29. Now it's looking more like it's going to be 20. Well, again, bid-ask price change. Certainly, you can be a bit patient with doing that. There is no rush to do those tweaks because you are still within the range. Okay, so I'm just going to go with 20 just so I get it executed, so I can be more visual in future sessions for you guys. But when you are doing this yourself at home, just take it easy. try to get as much premium as possible. Now we got 21, it says, instead of 20. So be demanding. You have the whole day to do it. Even if you don't do it today, you can do it tomorrow because you're still within the range. So it's fine. Okay, so no need to rush. Just make sure you get as much premium as you can. Okay, so again, let's review. Make sure I made no mistake. So we are buying the 230 and selling the 225. Is that what I did? Yeah, buy the 230, selling the 225, yes, and then selling the 255 and buying the 250, yes. So I'm just gonna confirm and send, and now the order is there waiting to get filled, okay? And whenever it gets filled, and if it gets filled, so what's the beauty? Well, the beauty is that we just collected additional 20 cents for this trade, okay? So 20 cents for this trade are going to help because, you know, when we did this iron condor, we got filled at 113, okay? So this was the iron condor. No, sorry, I didn't get filled at 113. Let me take a look at that one. So I'll get the pricing that I got from here. So we did 1 second, guys. I just want to do this as visual as I can for you. So for the iron condor, the prices that we got, trade price was 226 plus 132 minus 177 minus 1. Okay. Oh, sorry, guys, I didn't do this right. 226 plus 132 minus 100, okay, minus 177. Now I got it right. So we got 81 cents when we did this iron condor, okay, and we are now about, okay, so if I look at TradeStation, so I can go ahead and input here 0.81, okay, that would simulate, okay, that would simulate what we've got with this iron condor, okay, and this is the risk profile, okay. So again, now if you were to do this trade, let me go ahead and uncheck the real trade and check the simulation only. So if you got 81 cents to do this trade, so what's the most you can make? Well, obviously the most you can make is $81 as long as you stay within 305 and 230. Okay, so that's the amount of money you're gonna make. You know, the credit collected. This is obvious. Okay, if you have been trading credit strategies, you know this by heart. Okay, now what's the beauty now? Well, the beauty now is that you know, we're gonna get another 20 cents. So of course, also I got a change of strikes. Okay, so it's not gonna be 225. It's gonna be 250 and 255. Okay, and the total amount of premium collected now, instead of 0.81, is going to be 101. Okay, why? Because I'm about to collect additional 20 cents by doing the roll I'm doing. Okay, so what's the most you will make if you're right in the trade? You'll make 101. Okay, but now the range still is pointing at 305 at the top. Actually, we gain a little more, right? So let's call it 307. Okay, because we 306, something like that. Okay, and the bottom part, of course, the bottom part is now pointing at 255 instead of 230 or something like that, because we have been rolling those puts higher. Okay, so worst case, now we're gonna lose less. Best case, now we're gonna make more. And of course, the trade-off is that now the range is narrower. My purple area is narrower, is less wide than before. But while that's the case, you know, I believe that we should, and we probably do agree all, that it makes sense because, you know, I located 255 beyond what statistics would suggest. You know, the further away price will go from now until April 16. And on top of that, I got a collection of UFOs to defend myself. So I should be okay. Okay. Now, before I talk about tweak number 2, so I open your mind to what is it that we're going to do next if the trade keeps moving against us. And I would like to get another final confirmation now that I place the order. Here we go. We just got filled on the tweak number 1. Okay, so you can see how 30 and 25 are gone, and now I am short 255 and long 250. Okay, and of course now the P&L of Facebook shows negative. Okay, but remember that in the bag I got like 40 something dollars, so really the P&L is the same it was. Okay, it's the same as it was. It's just that I collected additional 20 cents that will become zero on the expiration date. Okay, so the fact that we see a worse P&L is not the case. It's just like what we did with AFL the other day, where we had an initial roll on the calendar spread. Okay, and hopefully you remember that. So everybody with me on tweak number 1, because I am about to do tweak number 2, or explain what tweak number 2 will be. Please give me some feedback, guys. This is important stuff. I need to make sure you guys are with me on all those different changes, because this is now getting a bit more advanced, isn't it, compared to the prior option sessions we used to have, okay, which, you know, we were just taking the trade and just waiting till the end. Okay, so this is a bit more advanced now. Okay, nice. Yes, so I'm just looking. Very good, perfect. Thank you, Christian. Very good, perfect, everybody. So anyway, so let's continue. So what's next now? Okay, well, we are just in a better position than we were before. Okay, but we are at risk, and from now, 2 things may happen. Price may go back down to the midpoint of the range and does whatever it does, and we reach April 16, and it's a happy ending. And now we just made more money. Okay, so great. Instead of making 81, we made 101. Perfect. Case number 2, which is what seems to be most likely, okay, is that price goes back up, okay, exceeds our 303, range, and then now we need to do something about it because we are proven wrong on the trade. Okay, again, by default, an iron condor has limited risk. So if you were to do nothing, and that was part of the trading plan, it's not like it's crazy wrong, because price may go above and then come back inside the range on expiration, and now you're still in profit. Because the beauty of credit strategies with options where you have protective units, like in an iron condor, is that the most you can lose is limited. Okay, the most you can lose is limited. So no matter what, okay, you are not going to lose infinite, even if you do nothing. So it's okay. But in any case, I will want to propose something to do here, okay, which I'm going to explain now. And by the way, the same thing I'm going to explain that you will want to do if price was to go higher is what you will want to do if price was to go lower and break the bottom range, which is unlikely but could happen. Just like the upper range was unlikely when we did the trade on March 10, and look at what's happening now. Well, the same thing could happen on the bottom part of the range. It is unlikely, but it could happen, right? And we need to be ready for anything that happened, okay? I would actually say that that's actually more likely, because if you look at the climate, we've been moving up 11 candles when statistics suggest 6. It's a normal thing to happen, meaning that, we almost double what's normal. So that market may be set for a strong correction, moving down clearly towards the midpoint of the range. That would be a nice one. But then what if it keeps going? So now we may get hurt on the bottom part. So again, we're going to have to do a tweak. Okay. So what's the tweak going to be like? Well, an iron condor is made of buy a call, sell a call above, and sell a put and buy a put below. That's an iron condor. So I'm going to pretend I'm going to get hurt on the upper side. Okay. So if price goes up and I get hurt on the upper side, what am I going to do? I'm going to do a similar tweak compared to the one I just did, which is I'm going to close the puts, and that of course would be for a profit. Okay. And then what I'm going to do is I'm going to reconvert my iron condor into an iron butterfly by selling a put and buying a put using the same strikes for the call and the put. And that what this would do basically is to move my purple area somewhere like that. So basically, I would be giving this trade another chance while we are traveling to April 16. I will give this trade another chance to hopefully allow me to be within that new range, before the expiration date and end up in a profit. And if not, well, then I'll take a loss, okay? Because again, we cannot stop that. But because of this new tweak, okay, what would happen is that now, again, one more time, we would be in a position where we would collect additional premium. Maybe it's going to be another 20 cents. Maybe it's going to be another 70 cents, whatever that is. So again, if you end up losing in the end, now the size of the loss is going to be even less. And if you end up profiting in the end, then the size of the profit is going to be even more. Okay. So again, we'll keep working on that one. So far, what we had to do for today, it's done. And that's it. Okay, so we're gonna move to the next trade. I'm taking a lot of time today, to be honest, to go over trade maintenance because it's needed, guys. So I'm just looking at the time, and I'm not so positive we'll be able to plan on many trades today. Maybe we won't have time for trades today, and if that's okay, again, we are meeting tomorrow. We are meeting tomorrow again. So then tomorrow I'll keep it very simple with the trade management, but at the same time, those are important instructions to be explained. So when you guys are doing this by yourself, definitely you know what to do, okay? Maka, so if will be done closer to expiration? Yeah, well, every day is closer to expiration, right, Maka? The thing is that, we need to add some rules on when to do certain things, okay, which I need to explain properly. I won't do it today if that's okay, because it's too much and I don't want to confuse. But basically, when I was drawing this particular dotted line, and you see price going outside of that dotted line, there is something to be done already. Okay, so yeah, the iron butterfly would only be done if the range is broken. Okay, we have to be violating the range to be able to do the iron butterfly. Okay, that's we need to. In other words, we need to be wrong to have such as a like kind of like last type of opportunity given to Facebook. We need to be wrong. Oh, I understand. You meant IB instead of IF. I got you. Yeah. So yeah, no worries. We need to be wrong, because you will see when we do it, if we have to do it, whenever we have to do it. Yes, you could put an alert, and it would be 303.74 mark. And you will see when we do the conversion to the iron butterfly that while we're going to take a significant new chunk of premium coming in, the problem is that the range will become way narrower. Now, hopefully that's not going to be a problem, because we're going to be closer to expiration. But if that was going to happen very soon, then it's a big penalty for the trade, because now you have a high probability to end up outside the range, because the purple area is going to become very narrow. That's the downside of an iron butterfly compared to an iron condor, where the range is very wide. Okay, but again, we cannot, we cannot call the broker and be like, hey, you know what, that iron condor I took, just pretend I never took it, right? So yeah, we cannot do that, isn't it? So the only thing we can do is to adapt to what the market can do and keep adding some actions that bringing some premium, removing some of the pain, and giving the trade a second chance, a third chance, and hopefully end up in a good place. Okay, and therefore for the iron butterfly, we want to wait as long as possible. For the rolling of the puts, to be honest, I would have done it already last week, because and today I would have done it again, because last week we were already pointing at 310. Okay, so I will have to add more rules on specific rules on when to do what. But before I talk about the when, I need to talk about the what, and that's what I was talking about today. I was talking about the tweak number one, right? So now if I say tweak number one, you get my point. Joanne, it seems that you're having a laugh out there. Very good. So yeah, Christian, AFL is actually doing quite well. You will see, I'm getting there now, and you will see why, okay? Very good. And rolling the calls, same thing. So if Facebook was to keep going down, okay, if Facebook was to keep going down, and the 267 line end up below 255, then guess what? We're going to take those calls that we have up here, and we're going to roll them down the same way today we rolled the puts up, okay? And keep working on dynamically, adapting to the new market condition with this iron condor, okay? Again, to explain the when, I had first to explain the what, okay? So today we talked about tweak number one for an iron condor. I got you, Joanne. I got you about the broker thing. That would be nice, right? To have a broker like that. That would be very nice. Anyway, so let's move to Philip Morris, okay, which is the next trade in the list, okay, and we'll talk about the management of this trade as well. So Philip Morris, it's a trade that we put together. That was March 11. Okay, this was our very first ever calendar. just real trades. That's what it is, exactly. Philip Morris was the very first calendar or horizontal spread or time spread, okay, that we ever did together in the room. And when we did this trade, let me bring it with TOS. So Philip Morris, okay, was a trade utilizing two expiration dates, where one is April 23 and the other one was March 26. Okay, so why April 23? Because this is where earnings are going to be reported. So potentially we're going to benefit from that increase of value of the options because of the increase of volatility. Where March 26 was utilized because that was the expiration date that was providing us with that arbitrage opportunity, using that very inaccurate term in this sense, but I guess it's good enough. So what's going on? What's happening to AFL? Sorry, Philip Morris. So if I load Philip Morris, okay, and we look at the option chain and we look at the analysis tab, so we have this trade here, right? So April 23, March 26, okay. This trade, it's basically giving us a PNL of -3, -1. With TOS, we can see -3, -7 now. So again, kind of breaking even. Okay, but when you look deeply or closely, notice that the options that we sold are trading at 20 cents, right? So out of $2.22 we collected when we sold them, we could buy them back for 20 cents and make $202 if we were to close the trade now. Okay, and of course the idea is not to sell those puts and that's it. The idea is to sell those puts and sell more puts, right? Because again, that's we want to be exposed to long and short puts all the way until we reach that expiration date of April 23. Coinciding with earnings. Actually, we want to exit the trade before that, but I guess you got my point. So now, when is the right time to do this roll? And we did that roll last week with AFL, and I commented that the right time for us to do the roll has to do with understanding the theta. Okay, so when looking at the 87 put and we look at the theta, it shows 10, okay, $10 of theta. Okay, now how many days we got until expiration? Well, we got like 2 days and a half, right? So we got half of today and Thursday and Friday. So just to keep it very simple, you take this number, which is 9 or 10, you multiply times 2.5, and that gives you 25 cents. Now, 25 cents is more than 17. In other words, we are already dealing with what I mentioned last week that I called fake Greeks. Okay, again, it's a normal distortion that takes place as we approach expiration date. And again, it's not like it's a distortion, it's built in the model. The model is also weighting the calculations based on delta, blah, blah, blah. So again, the calculation is absolutely right. But at the same time, you cannot get 25 cents if you only got 17 cents available. So in other words, probably it's time and it makes sense to go ahead and start considering to sell options using the next expiration date. Okay, there's still the 87 one, but now we can sell a new option with one more week to go, and that option would now pay us 49. Okay, 49. And definitely that's the right action to be taken, and this is an action to be taken right now. Okay, so let's do it. Okay, so where are we at? Well, we have the 87 put that expires in 26th of March, which is next Friday. We're gonna go ahead and roll it. Okay, and we're gonna roll it for the same put that expire on April 1st. Okay, so again, if we do the roll, one, you're gonna pay us 40 something, but for us to close the trade, we need to pay like 20 something. So in other words, it seems that we could collect additional 30 cents of credit by doing the roll now. And because the theta is already showing those fake Greek effect, So it's indeed time to do it, just like what we did last week with AFL. I think it was on Thursday, but today we are able to do it on the Wednesday. So I'm just gonna do it. Okay, hopefully I'm not going too fast. I'm just gonna roll it. We're gonna get to see. So my order is for 31 cents. So we're gonna get to see that get filled in a little bit of time, hopefully. Again, when you are doing the roll in your real account, take it easy. There is no rush. You can spend the whole day to do it. Again, time passing works in your favor. There is only 2.5 days to go. So the speed of time decay is quite intense, even though we saw fake Greeks, but should be quite intense. So again, if you don't do it today and you do it tomorrow, it's okay. But again, we already have a good reason to do it today. So I'm doing it, okay? So now, going back to TradeStation and to keep working on the simulation so you understand exactly the effect of what we're doing, well, if we were to do nothing, so the bottom part of this range is 85, the top part of this range is kind of 89 something, okay? And the most we would make on this trade, it's, let's call it $80, okay? So what happens if I do this trade? Okay, what happens if I do this trade? Let me take a look at how much. So that was 370 minus 222. So 370 minus 222, that was 148. Okay, so we paid 148 when we got into this trade. So we paid 148 when we got into this trade. Okay, so that's more accurate now. So again, the bottom part was 85.44. The top part was about 88 something, and the maximum profit was not 80, it was more like 70, something like that. Okay, so this is what the trade was providing us, the way we did it. Okay, now what happens now if we do this roll? Well, if we do this roll, instead of using the 87 put that expires in March 26, we're going to be using the 87 put that expires in April 1st. But we are collecting 31 cents additional in premium. So in other words, our price we paid of 148 would be diminished by 31 cents, bringing it down to 117. So if I make this to be 117, so what happens? Okay, well, the bottom part, instead of 85.40 becomes 85.20. The top part, instead of 88, becomes almost 89. And the maximum profit that was about 70 now becomes about 80. So everything has been improved, not in a major way because it's only 31 cents. Why only 31 cents? Because, hey, the VIX has been dropping. So the VIX is now down to 19. It was like 25 last week. I mean, you can also see it on the option chain. I was looking at that before I clicked the button, right? So you can see how from week 27, 2018, right? So you can see how the premiums are shrinking as the VIX is going down. That obviously is not good for this trade, okay? But at the same time, we're gonna be selling April 1st and collect premium and improve the trade effect. We're gonna be selling April 9 and collect more premium once April 1st shows fake Greeks. And then we're gonna do it again with April 16 once April 9 shows fake Greeks. And by doing all of this, okay, the risk of the trade will be limited so much that, could we still end up in a loss? Of course, especially if we break the range and price move very, very far away from the midpoint of the range. But again, the probability of being or ending up in a very, very bad position is going to be very low. And in any case, the pain should be extremely low risk, okay? So just doing what we're supposed to do here. So I have it documented here already on OptionStation Pro and TradeStation with Thinkorswim. I'm still waiting for this to give me a feel. So yeah, so just waiting for this to happen. We gotta be patient. I think it's not happened yet. Yeah, 12. Yeah, so we're just gonna wait. Okay, so the difference between 41 and 12 as you can see, it's 29, which is less than 31. My asking price is 31. So I guess I need a bit of patience here. Okay. Good. Okay. So this is when it comes to Philip Morris. And please, I'd like to have a little bit of a confirmation coming from you guys. So I know you got it and you know what I'm doing as I move into AFL, which is going to bring us to the end of the session today. Ahmed, we can do the same for AFL as well. Yes, that's exactly what I'm going to comment now. What is the least amount of premium we should accept for this role? As long as it puts you in an advantage, Maka, any. Because again, you have 1 week of expiration, as a difference between today and the next expiration date. So again, I would say it's always going to be worth it. It's not like you're going to be like, okay, I don't want to do the role unless I get at least, X amount of premium. I mean, could you have a rule about that, around that? Yes, you could. And then you could go for the week after. But also, if you go for the week after, you are capping on a lot of the Vega profits that would kick in if volatility would come up. So I would rather sacrifice premium collected and making money on theta, which is very appreciated when you do iron condors and trades like that. I would prefer to sacrifice on theta in exchange to expose myself more aggressive on Vega. So if the VIX goes back up, next thing you know, you're going to see the P&L of this trade to improve beautifully. I mean, let me show you that. So if I show you, let me see. Yeah, so volatility adjustment, okay? So take a look at what happens if I increase volatility. Okay, so if I increase volatility, what happens? So now I'm making money, $7, right? Just by having a 2% increase in volatility. What if volatility increases, 5, 8%? Okay, so what's happening now? Now the trade is making $37. I would not enjoy as much of this increase in profit if I was to sell 2 weeks further, 3 weeks further. Yes, I will get more premium. And therefore, if I'm thinking theta, I will get more of that. But I would miss on the potential increase of volatility. And because the VIX is low, and because those options contract had a low implied volatility, because that's how we scan using the scanner of TradeStation, isn't it? So the probability of an increase in volatility is higher than not. And therefore, I don't want to miss being exposed to that potential increase of volatility, okay? So that's why Maca, I will not be looking at a minimum amount of premium, and I will just do it. Okay. Siderman, you got your order in at 35 cents. Very good. Yep. Still 2.5 days to go. Yep. So anytime that you get filled at this price, perfect. Yep. Absolutely. Good. Okay. So now AFL. So AFL is the last one in the list. So now this looks like, okay, again, the way we plan the trade, we said, okay, this is a trade, this is a calendar spread. So we want this trade to remain range bound, and of course, started moving up pretty intensively. That was not too good. But then moving down even more intensively, that's definitely not good. Okay. So why? Because we are away from the midpoint of the range, and therefore, when you look at the P&L, so AFL is the one that looks the worst, isn't it? With minus 110. Okay. Now, having said that, you probably remember that with this trade, okay, we went ahead with this trade, and with this trade we have already. I'm just thinking multiple things at the same time. Sorry for that, guys. Let me start again. With this trade, we have already done an adjustment. The first adjustment was already done. So the P&L that you see here is not the real net P&L of the trade. The P&L of the trade is better than this because we already collected profits in the prior roll, isn't it? So now, I believe I documented this on TradeStation. Hopefully I did. So let me take a look. So if we look at AFL, yes, correct, I did. So yes, so I believe, let me see. So if I look at the prices, yeah, so 210 minus 50, okay, you would be like, okay, so for me to do this trade, 1 second here, bring the right calculator. So for me to do this trade, I pay 210 and then I got paid 50. So you would think that this trade cost you 160. But the reality is that this trade didn't cost you 160. This trade is costing you 102. Why? Okay, well, because we did the trade for whatever price and we collected already the premium from the front week, and then we sell a new option that added another 50 cents of premium. So the net cost of the trade so far is 102. So the most we will lose is 102. Actually, the net P&L of this trade, if you do the math altogether, is minus 32. Even though on TOS it shows as minus 110, because of course this is only showing you the positions that you currently have open. But if you were to count all together, I'm talking about the net result, the positions that you close on AFL plus the net open positions, so the net P&L would actually be much more, positive for us, which is minus 32. That's why I made that comment earlier, Christian, that while we are losing some money on this trade so far, is not that big of a problem so far. Okay, so what are we gonna do? Well, we're gonna do the same exercise. Okay, we are using the puts. In this case, is the 52. We are using 30th of April to buy and 26th of March to sell. So 26th of March happens to be the next week. Sorry, the next Friday. Okay, and therefore, when we look at the puts here, you can see that the value that we got here is 150 to 185. And here you would look at the theta and you would be like, oh wow, the theta is 7 cents a day, but I could get up to 150. Okay, well, that's not like that. Okay, that would not be the right way to do the math. What's the difference between the trade on Philip Morris and the trade on AFL? Well, the difference is that with the trade on Philip Morris went up. So the puts we sold were out of the money, and therefore the premium that we saw on the option chain was extrinsic value and would fully evaporate on expiration date. And we saw the fake Greeks. But in this case, with AFL, price is currently trading at 50.42, meaning below 52, and therefore the 52 put is in the money. Therefore, what you see here is a mix of intrinsic value plus extrinsic value. And the intrinsic value will not decay. That's why you can see the theta is a low value. So the question is, how much is the extrinsic value? Okay, and actually, you could actually add that. Okay, so extrinsic value, that's a value that we could add. Okay, let's put it next to theta so we can compare the theta with the extrinsic value. And you can see here how the 52 put has a theta of 7, but the most extrinsic value that we'll be able to collect is 9. So again, if you get 6 and you multiply 6 times 2.5 days, again, that's going to be like, let's call it $15. But wait a minute, the most extrinsic value available is actually 8. Okay, so it's no way you will be able to collect, $16. The most you will get is 9. Okay, so what are we gonna do? We're gonna roll, my friends. Okay, we are going to roll. Okay, now we're gonna roll for a loss. Okay, but we're gonna roll for a loss to gain additional premium. Okay, we're gonna roll for a loss in exchange to gain additional premium. That will help the trade, assuming price goes back to the closer to the midpoint of the range. If price keeps falling, it's not a good news. And by the way, there is another reason which is in this case is important for us to roll, which is to avoid any sort of assignment, because the 52 put is in the money. You may be assigned, and if you get assigned, now you are long stock. I mean, it's not like it's a big deal. And by the way, you collected the whole amount of premium without having to wait until the expiration date. So it's actually quite efficient to be assigned in a case like that. But it's not what we want, right? So because it has a margin implications, etc., etc. So rolling at this moment in time has two advantages, which is to avoid assignment because the option is in the money, and on top of that, to go ahead and collect new premium, which in this case is going to be 195 to 220, but careful, because the extrinsic value we're going to get, actually, wait a minute, I'm looking at the wrong expression there. We're going to use April 1st. Okay, now I'm doing the right thing. So 150 to 175, okay? But really the extrinsic value we're gonna collect, it's 19, okay? So it's not like we're gonna collect too much, okay? It's not like we're gonna collect too much, okay? But you know, we'll be happy. We'll be happy to take that one and go with it, okay? So so let's do it. Okay, let's do it. Let me come in here. So we are dealing with this. Okay, so we got the 52 put that we bought and the 52 put that we sold. Okay, problem: prices went down. So what's happening? The put we bought is giving us a profit. The put we sold is giving us pain. Okay, so we want to leave that put. Okay, we want to leave that put for the reasons I said. Sell the new one using the next expiration date, which is April 1st, and now we're gonna collect a little bit extra premium. Okay, so let's do that. TOS, where are you? Right here. Okay, so AFL, we're gonna right click to create a rolling order. Same story. Okay, and we are exchanging the 26th of March expiration 52 put for the 1st of April 52 put as well. Now here, and this is a great example following up with Maka's question earlier. Okay, in this case, the amount of premium you're gonna get paid is very, very low. It's like 8 cents, right? So again, I would take it. I have no problem. At the same time, I do need to be mindful when the values are so low. I do need to be mindful of the commissions I have to pay my broker to do the trade, because if the commission was not to provide any benefit, you know, why I'm even doing this, right? So you know, you have to keep that in mind. Okay, you have to keep that in mind. In any case, you know, as long as the commissions justify the trade, you just do it, because again, now you're gonna be again exposed to that Vega value, and then if the stock goes back to the midpoint of the range, this put that we are about to sell for a great amount of premium is going to recover plenty of the losses that were generated as the stock was falling down. So we're gonna do it. Okay, so here we go. Confirm and send. And again, this is not a very productive roll. Here we go. We just got the roll in. Okay, so we got filled at 8. So if you think about it, okay, for us to understand well what I just did, wow, I just surpassed the time for the session by 7 minutes already, guys. So we're gonna conclude this very quickly. But basically, what I've just done is move this to April 1st, and 102 becomes 94. Here we go. That's what I've done. So now the most I will lose is 94. The most I will make is a bit more. Okay, and the range is a bit wider than before. Okay. Notice that, you know, the most I will lose now is 21 instead of 30 something. I mean, those $8 additional I just got, it's the difference that you can see here. So again, keep working on improving the trade. You got 008, very good. Tradestation pace 005, not 008 like TOS. So go for 10, Ahmed. Go for 10 and just wait patiently. And if you don't get it today, you should get it tomorrow. Okay? Very good. Perfect. Okay, so we have it, guys. Intense session, lots of comments. No new trades today, but hopefully the session went well for you all. We didn't interrupt the stream on the public channels such as YouTube, Facebook, and so on. So you guys don't miss this, since it's the first time that we discuss it. But again, just keep in mind the process that we normally run, like we did last week, where, you know, the sessions are not so lengthy in the YouTube channel. Okay, in any case, if you guys sticked around, thank you for your support out there, and I will see you all tomorrow, my friends. Exactly, now we chose better results than before. Exactly, that's why we do it. That's why we do it. And again, this is, how do we put it? The beauty of trading options and running those strategies and do those adaptations is that it really teaches you not only how to use options, but it also teaches you how to go with the flow, right? to adapt and go with the flow with the market, and how to ignore the emotional impact of joy when you see the market do what you want it to do, because next thing you know, because you're going to be in the trade for multiple weeks here, so next thing you know, that the market is doing something you don't want it to do. So now you're going to learn to ignore the concern that market moving against you brings in, and then the market goes back to you, and then you're going to feel relief. So now you're going to learn to ignore the relief that this situation provides, and basically you become a much better trader by ignoring all your emotions, okay, and really feeling nothing, and just applying a methodology and a plan without getting emotional in any way. Of course, you need to repeat this many times to get to that level of, let's call it self-control. And again, I'm human, so sometimes I do get emotional too. That's for sure. But at the same time, these type of trades will really teach you and train you and force your mindset to go through those different experiences. It's a little bit like a healthy roller coaster, that then you go from the first time you went to the roller coaster, it was scary, to now you enjoy the ride so much, and you cannot wait to get into the next roller coaster and the next ride. Is that making sense? So hopefully this analogy resonates and makes sense. Definitely calms the emotions. Very good. You guys take care, my friends. See you soon. See you tomorrow. Total risk was minus 60. Now the risk is 50. Yep, that's what we're doing. Shaving that risk, and keep being exposed to some profit, and then the market will dictate what happens at the end. But we are trying to work intelligently in a scenario where we try to add odds in our favor with UFOs and all the tools we use, but still there is no certainty. So we are adding an extra advantage thanks to the use of options and those little tweaks that we do during the life of the trade. Very nice, everyone. Hope you're having fun. I do. See you tomorrow. See you soon. Bye-bye.